Have you or your clients ever wondered if gift tax might be incurred if they're planning on making transfers here at year end or in general to children, family, friends, loved ones at any time during the year as a future planned gift? Today we're going to get back to basics and look at how the gift tax is applied at a high level. I'm Griffin Bridgers, and before we get started, I want to remind you this presentation is being provided for educational purposes only, is not intended to substitute for legal or tax advice. So, whenever we make a gift, there's a bit of good news. The recipient of that gift, often known in formal legal speak as the donee, is not subject to federal income tax. However, that doesn't mean that there's no general tax that could be applied to the gift. Instead, there's a gift tax potentially that's imposed on the person making the gift, known in legal speak as the donor. Essentially, this isn't like the income tax, but instead is a tax on the privilege of transferring wealth during life. And in that vein, it shoehorns into the estate tax, as we'll bookend this presentation with today. But for now, this gift tax, while it seems scary, actually lacks teeth. For most people, it will not apply and probably will never apply. Why? Well, to start with, it's important to understand that each U.S. citizen or resident has a gift tax lifetime exclusion. That amount is indexed for inflation every year. Under current law for 2025, the inflation-adjusted lifetime exclusion against gift tax will be $13,990,000. What this means is you can give away up to that amount during life without ever paying a single cent in gift tax. Now, what we won't discuss today is that under current law, that amount is scheduled to be reduced by 1/2 at the end of 2025. But even with that reduction, a significant chunk of the U.S. populace will never incur any gift tax. Now, it's important to note too that while we can use up this lifetime exclusion, it does come at a cost because this same exclusion applies to offset estate tax at death. And using this to offset gift tax during life reduces the amount that's then available to offset estate tax at death. But there's another benefit above and beyond that large lifetime exclusion. This reflects the fact that the IRS doesn't want to track every little gift that you might make each year. Things like birthday gifts, wedding gifts, holiday gifts, GoFundMe donations. And because of the burden of reporting and tracking all of these small gifts, there's a generous annual exclusion given under the tax code. In 2025, that amount will be $19,000. Now, it's important to note that this $19,000 isn't per donor. Instead, it's per donee. This means you can give up to $19,000 to any number of people without dipping into your lifetime exclusion. So, to clarify that a bit more, you always use up your annual exclusion, if it's available, for any gifts during any given year before you dip into your lifetime exclusion. Now, as we'll talk about in a bit, this annual exclusion only is available for certain direct gifts. But before we get to that direct gift concept, let's look at an example. Let's assume we give $30,000 in cash this year, during 2025 to a friend. What would be our outcome? Well, in this case, the first $19,000 of that $30,000 would count against your annual exclusion. And then the next $11,000 would count against your lifetime exclusion. The outcome would be that there'd be no gift tax. But that $11,000 we use to offset our lifetime exclusion would reduce the lifetime exclusion available for future gifts in future years. However, that $19,000, since it's an annual exclusion, would be reset at the start of 2026 for this recipient and each other recipient to whom we might make gifts during 2025. Now, there's one problem in this example, and that is that anytime we make a gift that uses any of our lifetime exclusion, that $13.99 million, then we're required to file a gift tax return. So a better way to think of this is that any gift that exceeds that $19,000 annual exclusion with respect to any one or more recipients in any given year invokes this gift tax return filing obligation. So, is there a way we can work around this in our example? What if, instead of writing one check for $30,000, maybe your spouse or partner went in with you 50-50 and each of you gave that friend $15,000 so that you make a total gift of $30,000 from the two of you? In this case, what would happen then is that each of you would get to stack your $19,000 annual exclusion with respect to that one friend. The result is that each of you would use part, but not all of your annual exclusion. You'd use $15,000 each. And because we haven't used any of our lifetime exclusion, this means our gift tax return filing requirement will now be avoided. Pretty slick, huh? However, what happens if maybe your spouse or partner doesn't want to go in with you on the gift and only one of you could write the check? Is that one person writing the check forced to use their lifetime exclusion in full? Well, the answer can vary based on a special election available for spouses called the gift splitting election. Before we get to that election, if we have one spouse writing the check, we have the same results as before, that $19,000 of annual exclusion is used, then $11,000 of lifetime exclusion is used. And we still have to file a gift tax return to report the use of $11,000 of that lifetime exclusion. What if, however, we had an option maybe where we could look at a couple as one gifting unit and treat each spouse as making the gift half and half? The good news is that tax laws do create the option for that election. Even though there's no joint gift tax return available, there is an election you can make to treat all gifts that comes from either spouse, but not between them, as being made half and half for any given calendar year. So in this case, let's say one spouse wrote the check and this election was made, then we'd have the same results as if each spouse had written a $15,000 check to that friend, thus using part of their annual exclusions and none of their lifetime exclusions. But the bad news here is that to make this election, one spouse has to file a gift tax return. So whoever's writing the check here would file a gift tax return and would check a box to make this election, and then the other spouse who's not writing the check would sign that gift tax return to consent to that election. Let's take it a step further. Let's say maybe we doubled the gift to $60,000 and we still have just one of you writing the check. Well, in this case, we still have the availability of the gift splitting election, so we can treat the gift as being made half and half by each spouse. You'd each use up your annual exclusion, but the problem is now that each of you is now using $11,000 of your lifetime exclusions. So because each of you is now using part of your lifetime exclusion, the trade-off and bad news is that now both of you have to file a gift tax return. And because only one of you wrote the check, each of you has to consent to gift splitting on each other's returns. Now, we mentioned earlier that this annual exclusion of $19,000 per recipient in 2025 only applies to direct gifts. What if instead of giving that $30,000 directly, you instead put it into a trust for your friend? In that case, that gift will be known as a gift of a future interest under the legal definition of the tax code. And the significance is that because the recipient cannot immediately access the funds, this means that we will not qualify for the $19,000 annual exclusion. Only present interest gifts qualify for that $19,000 annual exclusion. Present interest are usually going to include direct gifts with no strings attached of cash or property, certain types of property, I should say, and it's typically going to disqualify certain types of trusts and other forms of gift where there's not immediate access. Now, the bad news is that we don't qualify for the annual exclusion, but the worst news is that you have to file a gift tax return for a future interest gift of any amount. Why? Because, going back to our original rule, because we don't use any annual exclusion, it means we have to use our lifetime exclusion to offset the value of this gift in full. Now, there are some exceptions to this future interest rule. They're beyond the scope of this discussion. I'd encourage you to ask your estate and tax planner about exceptions. Some to keep in mind are custodial accounts and trusts for minors sometimes will not be treated as future interest, even though a minor might not be able to access them until age 21. Likewise, 529 plans typically will not be treated as future interest gifts, and there might even be a special election to 5x your annual exclusion for any 1 year's contribution, as long as that is then absorbed over a 5-year period with respect to the beneficiary of that account. Some trusts that require all income to be paid annually may be treated as present interest and not future interest, and likewise, for some trusts, you may be able to manufacture a present interest by giving one or more beneficiaries what's known as a crummy withdrawal right for each contribution to the trust during a given year. Finally, let's explore what happens where if instead of transferring $30,000 in cash, maybe we transferred $30,000 in property like stocks. Well, in this case, we still have to file a gift tax return potentially, but the important part is that the gift tax applies to gifts of property as well. And the metric for doing so is the fair market value of the property that's transferred. So in this case, if we are required to file a gift tax return, i.e. if we're making a gift splitting election or using some of our lifetime gift tax exclusion, then we have to include documentation with our gift tax return to prove what the fair market value of that property might be. For publicly traded stocks, sometimes that can be easy to prove, but for other types of property where maybe if it's an interest in a family business, that is much more difficult to value and prove the value of to the IRS. Finally, we're not going to cover estate tax today, but as I mentioned at the beginning, the estate tax also uses this same exclusion of $13,990,000 that each U.S. citizen and resident is given to offset gift tax. But the trade-off, as I alluded to earlier, is that use of the lifetime gift tax exclusion will reduce dollar for dollar the amount available to offset estate tax at death. In other words, your exclusion against estate tax is $13,990,000 minus the portion of your lifetime gifts that actually use up this lifetime exclusion. Thank you for listening to today's presentation. If you have any questions, I'd encourage you to consult a tax and estate planning professional. But I hope that this helped, and I hope you've come away with a fresh perspective on the gift tax and how it might affect you.